Kotak Invest Maxima. Will this investment cum insurance policy maximize your returns and minimize your risk in the portfolio? Let us evaluate. Hi, this is Ramalingam from holisticinvestment.in. We help individual investors like you to achieve your financial goals faster and smarter. Before evaluating this policy, let us first understand the key features of this policy so that you will be empowered to analyze this policy. This is a unit-linked insurance plan. That means this policy will have charges, policy will have life cover, policy will also have units in which your money will be invested. These units are fund options which will invest in stock market and money market. So this particular policy has got a market risk. This is not a traditional endowment money back ULIP plan. Sorry, this is not a traditional money back policy. This is a unit linked insurance plan. One of the major disadvantages of ULIP, why people don't recommend ULIP, is premium allocation charges. But this ULIP claims there is no premium allocation charge. So this no premium allocation charge is in overall reducing the expense ratio of this ULIP. Because there is no premium allocation charge, will this result in a better rate of return? That we have to evaluate. We will note this point and evaluate. There is survival benefit in this policy. And there are two investment portfolio strategies which are there. I'll explain that later. A flexible premium allocation is there, fund options are there. You also have section 80C tax benefits, right? I told you there are two strategies, investment strategies. You have an option to choose. The first one is a self-management strategy. Here, as an investor, you will be picking and choosing which fund option to invest and in which combination you want to. There are 5 funds. You want to pick and choose 2 or 3, or you want to invest in all the 5. How much allocation to give? Do you want to give equal allocation? You want to give overweightage to one asset class like equity or more asset class to other asset class like fixed income? That you yourself will be deciding. There are 5 fund options. There are fund options which can invest 100% in equity, like a classic opportunities frontline equity. There are also fund options which will invest a maximum of 60% in equity. Also, they can invest maximum of 70% in fixed income. That way, it is kind of a balanced fund. There is also another category of fund which will not at all invest in equity. It will invest only in fixed income schemes. It is dynamic bond fund and money market fund. So all these 5 options are available. So where do you want to invest? Which combination do you want to invest? How much allocation you will do? And when you switch from one fund to other fund, all these things you will decide yourself. This is self-management strategy. Out of the 2 strategies, we have completed one particular strategy. What is the next strategy? Systematic switching strategy. This works similar to systematic transfer plan in mutual funds, where you invest a lump sum money in one particular scheme, can maybe an equity fund or a fixed income fund. From there, you transfer every month, every quarter, every year to another asset class or another scheme, right? Here you are switching from equity to debt, or you can switch from debt to equity. Like that you can do. This systematic switching strategy is also available. So out of these 2 strategies, whatever is comfortable for you, you can pick and choose. Survival unit benefit, maturity benefit, death benefit. All these are the total benefits given to investor. So as an investor, you are more concerned and very particular about maturity benefit and death benefit. So let us see them in detail, right? Death benefit. What is the death benefit? In case of an unfortunate death of the policyholder, then how much benefit will be passed on to the nominee or legally heir? That is what death benefit is all about, right? So that way, if we look at it, there are three fund options, values, which will be calculated by the life insurance company Kotak. Out of these three fund values, whichever is highest, that will be given to the nominee in case of unfortunate death of the policyholder. What are all those three fund values? Simple. Fund value as on date of death claim submission. Whatever the fund value, units value, which is there in the portfolio, right? This is the first value calculation. Second calculation, sum assured. Third calculation, 105% of the total premiums paid. Out of these three values, whichever is higher, that will be given as the death benefit to the nominee in case of unfortunate death of the policy holder. As we have discussed the death benefit in detail, we have to next look at the maturity benefit, because as an investor, maturity benefit is what more important for you if you are considering this as predominantly a investment option. So what do I strongly suggest here is, before going ahead and analyzing the return, there are few other important things that you have to look at it. That is charges involved in this particular policy. Yes, because charges, the overall expense can bring down the net return which investor receives. So let us look at what are all the charges. Some of the charges are open, some of the charges may be hidden to you. So I'm listing down all the charges here. As this policy claims, there is no premium allocation charge. There is policy administration charge. This is for like issuing policy, printing policy document, administering policy charges. This is something unique to insurance policies. These charges are not there for mutual fund investments. There they will not say account opening charges, account statement charges. These kind of entry charges are not there. Fund management charges, this is definitely an admissible charge, where you are charging 1.35%, up to 1.35% they are charging. It is admissible because to identify which securities to invest, where to invest, all those things they have to explore. Right. So 1.35% is definitely an acceptable charge. Switching charge, if you want to switch from one fund option to the other fund option. I explained you 5 different fund options, right? You want to switch from equity to debt, debt to equity. There are charges involved in it. These kind of switching charges are not there in mutual funds. This is again very unique to ULIP policies. Another unique charges which I would consider as not admissible or not justifiable charges, partial withdrawal. It is your own money which is there in the ULIP policy. When you withdraw partially, they will charge you. There is an exit load. Again, this is not justifiable charge. Then discontinuance charges. If you want to discontinue the policy before 5 years, again there will be charges between 2% to 6%. This is definitely a very high charge. Correct. Now, this kind of discontinuance charges are there, not there in mutual funds. In mutual funds, if you are committing an SIP for 5 years, after 3 years, if you want to discontinue your SIP, there is no charge for you. So this discontinuance charge is also an additional charge. However, the next charge, mortality charge, insurance companies charge to provide you life cover. This is again a feasible, admissible charge. There are also miscellaneous charges. There are some fine prints which we have to read and understand what is miscellaneous charges. So out of the total 8 charges which I have given, there is no premium allocation charge. Mortality charge is acceptable charge, and fund management charge is acceptable. Rest of the 5 charges under 5 heads or seems to be not recommendable charges, not acceptable charges. So that way, these 5 charges are not justifiable charges. These charges can negatively impact the overall return. Let us see what kind of return this policy gives. The illustration which I am showing here is the benefit illustration taken from Kotak Invest Maxima's website, Kotak Life's website, official website. I have taken this benefit illustration. They are giving illustration under 2 heads: benefits at 4% per annum, benefits at 8% per annum. But remember, this 4% and 8% is not the net return receivable by you. 4% is the gross return received by Kotak for their investments. After all the 5 heads of expenses and other 2 justifiable charges, how much they will give it to you, that we have to calculate, right? In a worst case scenario, Kotak has got the potential to give you 4% gross return. In a best case scenario, they have got the potential to give you 8% return. Now let us take expenses into account and find out what kind of return it works out. In a worst case scenario, after considering the expenses, it works out to 2.01% return only. In a worst case scenario, the net return received by you in Kotak Invest Maxima plan can be 2.01%. This is definitely a negligible return. This is lower than your savings bank account return. Next is 5.99% return. 5.99% return is the best case scenario return. Even at 8% gross return, it works out to 5.99% return because of the charges. Right? So because of these charges, do you have to really take this policy or avoid this policy? Because even after taking risk, this is not giving you a risk premium return. Even in a best case scenario, this has got the potential to give you only 5.99% return, which is just an FD kind of return. Even post office time deposit can give you a better return. Even RBI bonds has got the potential to give you higher rate of return. Now, let us compare these benefits, which is a life cover and also the maturity benefit with different investment combination. This policy gives you 10 lakhs cover. Can we get the same cover or a better cover plus similar maturity benefit? Let us try to create an investment combination and see how can I get same amount of investment? Can I get a better benefit? Let us find out. First, I am taking term insurance plus PPF as a combination. Instead of investing the 1 lakh premium in Kotak Invest Maxima, I am taking the same 1 lakh. Some portion of that is diverted to pay term insurance premium for 1 crore. There you get approximately 10 lakhs cover. Here you are getting 1 crore life cover, right? Balance money only I am investing in PPF. PPF is giving me the maturity value of 37.9 lakhs, whereas Kotak Invest Maxima is giving 38.9 lakhs. It is almost comparable, much closer, 5.77% return, 5.99% return. In Kotak Invest Maxima, it is 5.99. PPF, it is 5.77% return. So, however, PPF is a government scheme, not a private scheme, and it is giving you 7.1% assured return, right? Though it is giving you 7.1% assured return, because I'm adjusting the term insurance premium, the net internal rate of return for the combination term insurance plus PPF, it works out to 5.77% return. That way, if you look at it, This Kotak Invest Maxima takes higher risk and delivers almost equivalent to PPF return. Do we have to invest in Kotak Invest Maxima? Let us make one more comparison and see. Kotak Invest Maxima plan versus term insurance plus equity mutual fund combination. Kotak Invest Maxima plan plus term insurance versus term insurance plus mutual fund equity. Right? That depends. If you are looking for tax benefit, you can think about choosing ELSS in mutual funds, or you can go for any diversified equity fund. Based on your financial plan's suggestion, you can pick and choose the best diversified equity funds, including index funds. So when I have assumed it is invested in mutual fund ELSS and a combination of term insurance to the tune of 1 crore, not just 10 lakhs, 15 lakhs, 20 lakhs, I'm taking to the tune of 1 crore. So this combination of term insurance plus mutual fund gives you higher life cover and also gives you higher return, 9.82% internal rate of return. It gives you the combination of term insurance plus mutual fund ELSS. So what it works is over a period of 20 years, you are paying 1 lakh in Kotak Invest Maxima. Even in a best case scenario, it can give you roughly around 38.9 lakhs. Whereas in term insurance plus ELSS combination, it has got the potential to give you 61 lakhs. So this is much higher. You are getting much higher insurance benefit. You are also getting much higher maturity benefit. That way, 9.82% is definitely a risk premium return. 9.82% is a good inflation beating return. 9.82% is a good long-term return. Let me summarize the advantages and disadvantages in this policy once before going for the final decision. This policy gives you life insurance and no premium allocation charge. Section 80C benefits, multiple fund options, 5 fund options are given to you. Maturity profit based on the fund value is given to you. Partial withdrawal is possible after 6 years. Disadvantages, market linked product and lock-in period of 5 years. There are 7 heads of charges. Out of that, 5 heads of charges are not justifiable charges. So returns, we have to wait and see whether they will give you worst case scenario return or a best case scenario return. We have to find out. And the life cover given by this policy is not very appreciable. It's very less amount compared to a term insurance policy. So that way, because of these disadvantages, what I am suggesting to you is instead of investing in this policy, you can consider term insurance plus PPF investment option. If you are a conservative investor not willing to take risk, you can consider. Or if you are an aggressive investor who knows about stock market ups and downs, you are comfortable, like staying the course for 7 years, 10 years, then you are an aggressive investor, risk-taking investor. Then you can choose the combination of term insurance plus ELSS mutual fund option. We have done a detailed analysis on this policy, in-depth research. We have submitted that in-depth research for your personal in our website. It is available as a blog post. You can click the link which is given in the description of this video and read the research analysis of this particular article in our website. If you have any questions on this policy or any other investment proposals or any questions related to achieving your financial goals, then feel free to book a complimentary free appointment with our certified financial planners. Yes, there is an appointment booking link which is given below this video. You can click that link from the description box and just register with your preferred timings. Your call can be scheduled with our certified financial planner. We regularly organize investment webinars to educate investors. Again, it is completely a complimentary free webinar. If you want to learn how to achieve financial goals, if you want to learn how to multiply wealth, what are all the long-term wealth creation strategies, investment techniques, then our webinars are the right place to learn those strategies, techniques. I have created one more link, which is also there in the description of this video. That just leave your name and email ID. I will make sure you are getting the invite for the next webinar. Please participate in our webinar and get to know important investment strategies. Hope you like this video. I'll again meet you with yet another useful video. Thank you. Bye bye.